Regional bank shares did post gains today. Some of those regional banks, after the collapse of Silicon Valley Bank, sent shockwaves throughout the financial system. Also initially put a tremendous amount of pressure on the bank stocks that you are looking at right now earlier this week and the end of last week. Well, Signature Bank followed suit after the collapse of Silicon Valley Bank. Now, many are wondering if more failures are to come. So what is that potentially going to look like? What does it mean here for the Fed's fight against inflation? For more on that, to answer those questions, we want to bring in Financial Times U.S. financial commentator Robert Armstrong. Robert, it's great to see you here. And I know you recently wrote for the Financial Times an article there asking that exact same question. Is another bank at risk? What do you think?
I think your previous guest, the Morningstar analyst, put it quite well. Another bank doesn't have to be at risk here. If you look at even at the stocks, the bank stocks that have been under the most pressure, their balance sheets and their risk management look very different from what we saw from Silicon Valley. The problem is that at moments of stress, rationality doesn't always predominate. This is a classic case of all we have to fear is fear itself. If people are jumpy and they do a run on a bank withdrawing deposits, anything can happen, which is, of course, what the authorities tried to prevent by announcing that unsecured depositors in Silicon Valley Bank would be protected and that there would be a liquidity facility for other regional banks. We just have to wait and see if that works.
So where we stand right now, Robert, would you say these banks, let's call it the most middle of the road, the regional banks will still exist, but on a smaller, just a smaller basis, or do you have a few that may not survive?
I don't think there are any that have an obvious existential threat right now. Okay. Again, on the basis of their financials. They look, even the ones that are under pressure look solvent. You know, the list that you're showing right now is a perfect example of that group. Those are good banks. I think the more interesting question is over the long term, over the short term, do we get a panic that takes a solvent bank down? That's a possibility, but unfortunately, it's impossible to predict. Over the long term, the question is, what is the place of the regional bank in the American banking system and in the American economy? Because the stresses of this week show us that the system is not, as it were, perfectly tuned.
Well, the stresses of this week, Robert, also brings into question the Fed, how the Fed is looking at all this, if this does actually pose a risk, if this is going to impact Fed policy here at the next meeting. What do you think?
It will impact Fed policy. And I should say that this is a very historically normal phenomenon. At the end of central bank rate increase cycles, funny stuff happens. Things break. And when things break, that spooks people. And when people are spooked, the economy slows down. So what we are seeing, this time it happens to be Silicon Valley Bank. 30, 40 years ago, it might have been the S&L crisis or, et cetera, Asian financial crisis. When the Fed tightens, stuff happens. That leads to a slowing of the economy. So the Fed has to be aware of this phenomenon. But they're in a very, very tricky situation. They have this reality on the one hand, that there is stress in the financial system, and there will continue to be stress in the financial system. And as we saw from the CPI, most recent CPI print, inflation is still too hot. So they can't simply pause. But this has to be part of their deliberative process in the months to come.
And finally, even if all these banks remain solvent, which we do indeed hope, what's the impact for everyday Americans on the lending environment out there, at least in the short term?
Well, if banks have to be more conservative to protect their balance sheets in an unstable environment, that means they're going to be more careful about lending. So that you're going to see, as you always do at this point in the rate hiking cycle, when stress starts to rise, what you're going to see is it's going to be harder to get approval for a mortgage, a car loan, a credit card, et cetera, because banks are not going to want the risk.
All right, Robert Armstrong, got to leave it there. Financial Times, really appreciate the conversation, sir. Thanks so much.